All right. Well, hey, everybody. Thank you for joining us today. My name is Gaines Duval, and I am the owner of Duval Financial Group. Our goal today and what we're going to share with you is so that you can learn a little bit more about what we do for our clients, how we might be able to help you, and what the next steps would be from here. So at Duval Financial Group, we help people with retirement solutions, capital preservation, and insurance protection. Now, some of the things that fall into those categories that you may have heard of before would be things like IRAs, Roths, 401k rollovers, annuities, insurance products, etc. So there's a lot more that we do. We'll expand a little bit more into it in a minute, but those are some of the things that you may be familiar with already. Now, one of the things that we really pride ourselves on at Duval Financial Group is that we are completely independent. And what that means is that we don't work for anyone other than you, our client. So we have contracts with hundreds of different companies out there that all have multiple different products and solutions that may be of benefit to you. And so when we meet with our clients, we find out what makes sense for them based on their goals, their needs, and we go to the right company and find the right solutions for them, as opposed to some other people out there may work for one specific company and they can only sell you products from that one specific company. In our case, we find what's best for you. So I mentioned earlier that we do retirement solutions, things like Roths, 401ks, rollovers, IRAs, LERPs, and other tax advantaged vehicles. Everything that we work on with our clients is going to have principal and capital preservation and protection. What that means is that the money that you put into these accounts is never going to go backwards. You're not going to lose money from these accounts. Some of the products and solutions that we use have guaranteed lifetime income, similar to like a pension or a social security, etc. And everything that we use has predictable, reasonable, powerful earning potential. So a lot of it has proven history of incredible growth in the past, and it's proven, it's not speculative. The majority of the products that we use are also going to be tax deferred so that you're not paying taxes till the end. Or some of the products that we use will have you pay taxes now and then it will grow tax deferred and there'll be no taxes at the end. And like I mentioned before, zero market volatility. So what that means is that when the market goes up, your money goes up. But when the market goes down, you don't lose any money. So those are some of the bullet points on retirement solutions that we use with our clients. Now, I mentioned that we also help people with insurance needs. We help people with things like term life insurance. Now, term life insurance is pretty straightforward. Most people understand what that is. That's essentially life insurance that provides financial coverage for your loved ones if you were to pass away at a guaranteed fixed rate for a limited period of time, similar to renting coverage. So if you rent a home, you get a place to live, it's necessary. That roof over your head for your family is very important. You have to have it. But when your lease is over, you walk away from that house, you don't get anything for it, but it did serve a purpose during that period of time. Now, depending on our clients' age, their income needs, their expenses, the age of their family, etc., we generally are going to recommend anywhere from 10 to 20 times their annual income in some form of term life insurance. We've also noticed lately, especially, that most of our clients that are the people that come to us before their clients have the old kind of life insurance. Now, the old kind of term life insurance is exactly that. It's just life insurance. So if you die, X amount of dollars is passed over to your family, 100% tax-free. But the new kind of life insurance and new term life insurance specifically, not only has the pricing gone down a little bit in term life insurance, but it also includes living insurance. And living insurance would be something like if you needed to go to a nursing home, or if you had a heart attack, or you got cancer, you can use a portion of that death benefit while you're alive. So sometimes, even when people come to us for help that already have term life insurance, it makes sense to look at replacing it with a newer kind of term life insurance. We also do a lot in the permanent life insurance arena. Now, this isn't for everybody. It's for certain types of people, and we have to specially design our policies to make sense for those clients. But permanent life insurance is still going to provide that death benefit and those living benefits I just mentioned, but for your entire life. Plus, it's going to build cash value, which means it's more like owning your coverage as opposed to renting it. So if you own a home and you're making those monthly payments, you're building equity in that house. And if you sell that house or need equity out of that house, you can use that. Same with permanent life insurance. The cash accumulation is inside a tax deferred bucket that can provide tax-free income at or before retirement. It's not something that you can only touch after you retire. Absolutely no risk when the market drops in the vehicles that we use. We also have a program we call private family banking for somebody who maybe they want our help, but they're up to their eyeballs in debt. This allows them to help pay off debt quickly. They build their own bank, their own cash flow system that they can use with tax deferred growth, tax-free withdrawals for a new car, college, retirement. They can also take loans, which is something we can educate you on, which is super powerful. And in most states, it's protected from lawsuits and bankruptcy. And on top of all of that, you've got some incredible guaranteed growth inside of private family banking, permanent life insurance. All right, so now let's dive into a story. And this story is going to be about the typical American family. Now, most people that see this story or hear this story can find themselves somewhere in this story. And at the bottom of this mountain we see here is a family of four. This stick figure family of four is at the bottom of the mountain, which represents they're just starting their careers. They're married, they have a couple kids, they've got a solid foundation of what they're going to do for the rest of their life, and they're going to climb this mountain to get to the top of the mountain, which would be, we call it the pinnacle. A lot of people would refer to that as their retirement, right? Time to retire. We like to call it the pinnacle because what we mean by that is that's the pinnacle of their financial life. That becomes the time that they no longer have to worry about money. Now, they may decide to never work again, or they may just decide to work differently. So we're going to pretend that this family at the bottom of the mountain is making approximately $100,000 a year. And we're going to assume that they are really good stewards with their money. And because of what other people have told them, they're taking 10% of what they make a year and they're putting it into one of two sacred cows, saving for the pinnacle, saving for the top of the mountain. Now, the two sacred cows that we see most people taking their money, their retirement money or their retirement savings, we see them mostly putting their money into a 401k or an IRA because that's what they've always been told to do. We're going to assume that this family does this for 30 years in a row. $10,000 a year into their 401k and IRA every year for 30 years. And because of what they think the stock market has done, they think they're going to get an 8% return every single year for those 30 years. And if they do that, if they put $10,000 a year away for 30 years into their 401k or IRA and get exactly 8% every single year for 30 years, they will have approximately $1 million when they get to the top or the pinnacle of their mountain. Now I'm going to pause here for a second. And I want to say that if this family actually does exactly what you see here, I would give them a round of applause. I would give them kudos and I would tell them, great job. Congratulations on being good stewards with your money and saving 10% of what you make every year for all of your working years. But I will tell you that there are some major holes in what you see here. The problem is that most people will stop at this. They think, I'm putting 10% away, I'm good, it's all going to work out in the end. And it could, but it also couldn't because of the things we're going to talk about now. And these are the things where we want to step in and help our clients. One, what if somebody in this family all of a sudden becomes disabled? The income stops or it goes way down, or there's added expenses to the household. that's going to probably send this family right back down to the bottom of the mountain. What if one of these members in this family dies young? Income stops, or income goes down, or added expenses to the family is just going to send them right back down to the bottom of the mountain. And thirdly, and then I'll be done with the doom and gloom part, and we'll move on to more exciting stuff. And that is, what if one of these people ends up needing long-term care? They need to go to a nursing home, or they need somebody to come to their house to take care of them. And I'll tell you right now, this doesn't just happen to elderly people. One of my own family members needed long-term care in her early 30s. One of my best friends needed long-term care in his 30s. These are huge financial stresses on any family and will send them right back down to the bottom of the mountain. Now, the next thing I want to address that this family may not be thinking about is average returns of the past. What you'll see a lot of people do that help people plan for their future is they're going to take average returns from the past and use those to predict future returns as an average number. And you can't do that in good faith. Let me explain why. I'm going to give you an example. If I've got $100 and my first year investing this, I lose 50% of my money, that means that I have $50. So I'm down 50% in year one. Well, if in year two, I gain 50%, I'm not back to even. 50% of $50 is 25. So I'm back to $75. So I am down 25%, but my average rate of return, negative 50% in year one, positive 50% in year two, my average rate of return is 0%, but I'm down 25%. So as you can see, it would be unfair if I used an average return of 0%, telling these people that they're not going to lose any money, when in fact, they've lost 25%. So when you predict your future growth, number one, it's impossible to know exactly what your money is going to do in most vehicles, but you also need to use actual returns from the past, not average returns. And we can dive into this further in a separate meeting. Now, the next thing that we need to think about is that the stock market does sometimes go down. So let's pretend that this family is going up this mountain. They're actually getting 8% every single year. What if we have a market crash about 20 years in, or 25 years in, or 29 years in? And most people will say, well, that's okay, just leave your money in there, it will rebound. Well, in 1999, the market had done really well for quite a while. And then in 2000, the market crashed. And everybody said, leave your money in there because it will bounce back. But it didn't. It continued to go down in 2001. And people said, leave your money in there, it will rebound. But it didn't. It continued to go down in 2008. And then it recovered. And it wasn't until 2007 that the market was back to where it was in 1999. And then we had what everybody remembers, the 2008 stock market collapse. And it wasn't until about 2011 that the market was back to where it was in 1999. So 12 years had gone by with essentially no growth in the stock market. And so the question that this family needs to ask themselves is, when is the next crash coming? Now, most of you that are watching this presentation were hit by the March of 2020 crash when COVID was first introduced to us publicly. And just from a little bit of panic, the market dropped drastically in 1 month, less than a month. Was that just a teaser of what's to come? Is there going to be another big market crash in your lifetime? Well, if you look back on history, there probably is. And when we have that next market crash, how long is it going to take to recover? In this example, we had 12 years between two crashes that people's money had not grown at all in the market. Now, The next thing I'm going to address is by far the biggest problem and the most important thing that we need to talk about. And that is this number here. And in fact, I need to update this. It seems like every time that I use this presentation, I have to update these numbers. That says right there, $27.5 trillion. It's closer to 28 trillion now. And that represents our national debt. Now, I want to explain to you how big $1 trillion is. I could give you over $33 million a year for over 33,000 years in a row, and I still have only given you $1 trillion. That's how big $1 trillion is. And we have 28 of those as debt in this country. Now, a lot of people say that, hey, we just need to vote differently, and they get political on this. And I'm going to get political in a second, but I'm just going to dog everybody on this one. So you can't get mad at me. And I'm going to show you the history of our national debt. Now, this needs to be updated for the rest of Trump's term and now for Biden's term. But when we look at the history of the national debt, as you can see, we have a slope that essentially is going up at about the same percentage no matter who we vote for. So who you vote for is very important for a bazillion reasons, but it doesn't seem to help the national debt. Now, every single economist says that we need to address the national debt. The question is how do we fix it? And most economists, most people in the financial world will tell you that the only way we can address it is by raising taxes. Now, here's the irony in all of this. When Ronald Reagan became president, we had the biggest tax cut in the history of the United States at that time. And the reason why is Ronald Reagan was getting hit by taxes like crazy when he was an actor. Back then, people that were in a high income bracket or high tax bracket would be paying over 90% income on all the dollars they earned over a couple $100,000. Can you imagine every dollar you earn, 90% of it going back to the IRS? Now, if that's something you'd like to do, you're welcome to always send a donation to the IRS. But most people don't want to do that. So when Ronald Reagan became president, he cut taxes big time. Well, taxes really, other than a couple little ups and downs here and there, have continued to go down and are currently, at the moment, the lowest that they've ever been in the history of the United States. So we have this national debt problem that every economist says we need to raise taxes to fix, but yet our taxes have continued to go down. So I think we could all agree that while we don't have a crystal ball, taxes are probably going to go up. Now, here's the biggest problem with this story you see here. We'll pretend that this family climbed to the pinnacle of their mountain. Nobody became disabled. Nobody died young. Nobody needed long-term care. They actually got 8% every single year. The market never crashed, and they have $1 million in their 401k IRA. The problem with that is that their 401k has never been taxed. Their IRA has never been taxed. So on the other side of this mountain over here is this guy. And this isn't Pac-Man. This is representing the tax man. And the whole time that this family's climbing this mountain, this guy's getting hungrier and hungrier and climbing the mountain. And by the time they get up here, without us having any clue exactly what taxes are going to be, what we do know is that he's going to take a huge bite out of that 401k. Now, are taxes going to be 90% again? I don't know. I doubt it. But if you're in a 12% tax bracket, do you think they might be at 20 or 30%? Or if you're in a 24% tax bracket, do you think they could be 50% when you retire? So here's the problem. This family never paid taxes on any of the money that they put into their 401k and IRA. And that's a big deal. So now, even though I can't directly see you on the other side of this presentation and what you've watched today, I'm pretty confident that you look exactly like this right now. And you're saying to yourself, Now what? What do I do? And that's where we come in to help. So what we're going to do from here is we're going to collect information from you, find out where you are, just like that family that we looked at, that stick figure family. Where are you at on the climb up your mountain? Are you doing it right? Are you preparing for a little trip as you're climbing up the mountain? Are you preparing for a big fall? Are you preparing for the fact that maybe the mountain takes you on a little detour and takes you a little longer to get up there? Those are the things that we're going to look at. And we're going to create a foolproof plan, however you want to spell it. And we're going to focus on these three things for you. We're going to focus on protection. Again, make sure that if anybody becomes disabled, anybody dies young, or anybody needs long-term care in your family, that you guys are going to all be okay. And then we're also going to help you with growth. We want your money to grow. It's easy to protect your money and have absolutely no growth in it, like in a savings account, but we want your money to actually grow, but still with no market risk, huge upside potential, and proven historical growth. And lastly, we're going to focus on a tax advantage strategy to where you pay less taxes over your lifetime. You don't have to worry about tax penalties, and we prevent the IRS from controlling your money. So, like I said, the next step is this. Whoever shared this message with you, or if you want to reach out to us individually, reach out to them or reach out to us and just set up a consultation for us to just ask you some questions. Then we'll go to the drawing board. We'll show you where you are on the climb to the pinnacle of your mountain and what things we need to address, and if there are solutions that would make sense for you. Thank you so much for listening. We really appreciate your time, and we look forward to talking with you soon.